Howdy guys, welcome back to the Honda Show. I've been thinking about selling my wife's target date fund since last year because I think it's a very risky instrument. I sold $50,000 worth of funds this morning and rolled over the money into S&P 500 index funds this morning. You can see it on the screen. This is what I sold this morning, and tomorrow morning the account will be updated and all of the funds would be in index funds. Today I'm going to present to you why target date funds are so risky, and if you can, try to avoid them. Target date funds have become very popular of late, especially after 2006 when the Pension Protection Act was passed. PPA also provided the framework for auto-enrollment of people into 401ks. Target date funds are aligned with your age and when you're planning to retire. So say if you buy a fund saying Vanguard Target Date Index Fund 2060, it means that you're planning to stop working in 2060, and that's how the money is allocated between stocks and bonds. The funds, they start with very high equity allocation starting from 80 to 95% when they start, and as you age, equity allocation keeps going down and bond allocation keeps going up. Most people do not elect a fund into which they would be contributing. The fund gets elected either automatically or their financial advisor elects the fund for them. Most people keep contributing to their 401ks without realizing where the money is going to, and this is where the risk lies. The funds themselves, that is the target date funds, they keep getting more and more conservative as you age. The bond allocation keeps going up, which in today's environment is very risky. Generally speaking, target date funds are set it and forget it kind of funds. You don't have to do anything to them. Once you buy them, that's it. You don't have to do anything. They rebalance themselves at the end of every year. The most overpriced investment in today's market is long-term bonds. The bond bull market has been intact for 3 decades. This has also been the golden period for central banks because they could keep lowering interest rates and stimulate the economy. But now that we are at 0% interest rates, it's very difficult for central bank stimulus to work. Right now, the 10-year treasury is a little above 1%. Imagine if this was a stock, the PE is close to 95 and 100, with a guarantee that the income would never increase. Would you buy a stock like that? What I just said is the most profound statement in this lecture. If you want, go back, listen to it a few times, and you will realize what I'm talking about and why target date funds get riskier as you age. So I tried explaining this to you only so you realize that bonds today are way more expensive than stocks are. Compared to the past, the stocks are also very expensive. The CAPE ratio is at all-time highs. But when you compare stocks to bonds, stocks are still comparatively very cheap. Putting all your money into stocks is kind of a no-brainer, especially when you look at central banks and their policies of keeping interest rates at close to zero or very low for as far as the eye can see. So in this scenario, as your bond allocation in your target date fund increases, so does your risk. Like all other financial products, target date funds, they also come in active funds, passive funds, and you also have the third flavor, hybrid funds. But all of you guys out there who have been following my channel know my love for passive index funds, which I think are appropriate for 99.9999% of the people out there. So make sure if target date fund is the only option that you get to choose, or you have to choose that, make sure you use a passive target date index fund. This will give you the best performance with the lowest expense ratios. Pause the screen if you have to see how low these expense ratios are and how efficient these funds have become. The only thing you can control in investing is the fees. So it is very, very imperative that you choose a fund which has the lowest possible fees. This is where my other love comes in other than index funds, which is Vanguard. If you look at a basket of funds, Vanguard consistently has the lowest fees in the industry. Target date funds are still pretty new, and actually how they perform, you will get to know that after 40-50 years. Experimental Monte Carlo simulations have been done comparing target date funds with 50-50 and 60-40 stock and bond balanced funds, and target date funds usually come short. So don't be the experimental bunny and don't let the system try new financial products on your back, because remember, there is no loan for old age and you don't want to take a chance. The thought process of being aggressive with your investments when you're young and becoming progressively conservative as you age is very flawed. First of all, like I told you in the earlier part of this video, bonds are very expensive right now, so your forward returns are next to nothing. And the second reason is life expectancy keeps going up. Life expectancy is already around 80 right now. Life expectancy was around 70 in 1950s. So if you bought more bonds as you aged back then, it was okay because you had not many years to live on passive income. But now you have to live a lot of years on the passive income, so you can't be taking risks of running out of money. Medical insurance with pre-existing condition costs a lot of money, and most people tend to have pre-existing conditions conditions by the time they are 60, 65, 70. So medical insurance itself costs a lot of money. And God forbid you have to go to a nursing home, that costs between $5,000 to $7,000 a month. God forbid if your spouse is alive and both of you need to go to nursing home, that's like $14,000 a month. That's a lot of money. So you gotta be financially prepared. Most people work very hard, study hard, or work hard to get into a profession, get into a business. But when it comes to investing, they just want to hand over their money to somebody so they don't have to deal with it. I would strongly suggest you spend a little time every year educating yourself about finance. So when you talk to a financial professional, a financial advisor, at least you can have an educated chat with that person. If you don't feel comfortable with 100% equity allocation like I do, go ahead, buy a Vanguard 60/40 balanced fund. Alright guys, let's get down to the conclusion. Let's see what is important for you so you remember all the points and you make the right decision. Invest in a 401k if that's the only option available to you in your retirement plan. If you choose to invest in a target date fund, make sure you invest in a target date fund, which then invests in an index fund. So you get the benefit of low expense ratios and no risk from active management. Depend only on your income. Don't sell any assets, at least till the point you start collecting Social Security. The most important reason to avoid target date funds is to avoid bonds at today's prices. The biggest advantage that they tout for a target date fund is that it's a one fund solution, but so is an index fund. If some strategy is very simple, like investing in an index fund, people don't like it. They like to make it complicated. So they tinker with it till it gets a little complicated. They get some satisfaction out of it and they think they've achieved something. Remember, the risk in something is not just the volatility. It's also you outliving your investments. You don't want to be in that situation. So guys, I explained to you why you should not invest in a target date fund, and I'm not just telling it to you. This morning I sold about $50,000 worth of target date fund that I have and reinvested that money in the index fund. Hopefully you don't put yourself in a risky situation. Do not invest in a target date fund. Put money in the index fund as long as you're fine with 100% equity allocation, which I'm fine with. If you enjoyed this video, if you found this video useful, give me a thumbs up, subscribe to my channel. If you have any questions about target date fund or index funds, comment below. I'd love to answer them. See you in my next video.